If you look at your portfolio this week, you might feel confused. You might be down 5%, maybe even double digits. My personal portfolio is down more than 8% in the last 10 days. And I will be honest, it does not feel good. But if you look at the S&P 500 index, nothing is happening. It is flat. So, what is going on? First, welcome back to Rebuild Finance. This channel documents a real long-term investing journey, building a portfolio step by step, and sharing the thinking behind every decision. My goal is simple: find elite businesses, buy them at fair prices, and hold them for the long run. Many investors are selling out of fear right now. We need to talk about why the market is crashing for some companies and booming for others, and whether you should be selling your stocks too. For the last 2 years, the story about AI was simple. It was a bullish AI story. We all believed that AI is a tool. We thought, okay, AI will make employees more productive, and under this narrative, software companies were winners. More productivity means more usage. But in the last few weeks, that narrative has flipped. The market has stopped looking at AI as a helper and started looking at it as a replacement for the software company itself. The new story is AI does not just help the human use the software, it makes the software unnecessary. Think about it. If I can ask ChatGPT to file my taxes and it does it instantly, I do not need H&R Block. If I can ask Sora to create a brochure and it gives me the final PDF, I do not need Adobe InDesign. There is a post going viral right now from Matt Schumer that perfectly explains why Wall Street is terrified. He explains how his own job changed due to AI. 2 years ago, he used AI as a helper. Today, he describes what he wants, and the AI does everything. From 2022 to late 2025, AI went from struggling with basic arithmetic to performing the work of the best engineers in the world. If the AI can deliver the final result directly to me, why do I need the middleman? Why do I need to pay a subscription to a tool I no longer open? This realization has caused a violent rotation. Investors are suddenly dumping companies that sell digital tools and fleeing to companies that operate in the physical world. The market is asking a terrifying question. If AI gives me the result for free, does this software company even need to exist? Next, let's look at some companies to really understand the magnitude of the fear in the market. Let's start with H&R Block, which is the perfect example in my opinion. H&R Block sells compliance. They take the headache of taxes away from you. For years, they have been a safe, boring dividend stock because taxes are complicated and unavoidable. In just 2 days, the stock lost more than 12% of its value. From a valuation of $33 per share, it decreased to almost $28. Do you know why? Because new AI agents can fill out the forms automatically. The fear is not just competition. The fear is that the government itself could use AI to autofile taxes for everyone for free. If taxes become effortless, nobody pays H&R Block $100 to hold their hand. The market realized that H&R Block's profit margin comes from friction, and AI removes this friction. Another example I want to look at in more detail is Adobe, which in my opinion is the critical example. Adobe sells the tools of creation: Photoshop, Illustrator, Premiere. Their business model relies on the fact that creating professional content is hard. You need to pay them to access the complex tools that make it possible. AI makes the creation of content easy. With generators like Sora, the learning curve is gone. I do not need to know how to use a pen tool or color grade anymore. You can just type a few sentences in an AI tool and you will obtain the desired result. The fear for investors is simple. Adobe might be losing the mass market. The millions of small business owners and marketing managers who used to pay for Creative Cloud are now realizing they can get good enough results from AI for pennies. This is why Adobe is down almost 25% this year. The case of Adobe is particularly important in my opinion because this is not the first time investors believe that AI will disrupt their business model. This fear started years ago and it has been dragging down the stock price. The stock price of Adobe was almost $600 at the beginning of 2024 and it has decreased significantly since then. But if you look at the financial statements of Adobe in the last 3 years, we can see something that is worrying. Revenues increased by more than 10% per year from 2022 to 2025. Yes, you heard that correctly. Adobe kept growing at double digits, while the stock price fell more than 50%. Moreover, we can also see that the growth in revenues was also matched by a growth in earnings per share, a small growth of almost 5% in 2024 and a massive growth of 35% in 2025. See, one last point. The company generated healthy free cash flow every single year. And yes, that cash flow kept increasing. So the message that we can get from the example of Adobe is clear. Even if a company is growing and has sound business fundamentals, the stock price can suffer for years if the market believes that AI will destroy its future. Adobe is currently trading at a PE ratio of just under 16, while the forward PE is only 11. Think about that. A forward PE of 11 for a tech monopoly growing double digits. It is priced like it is going bankrupt. And despite this cheap valuation, the stock continues to lose value. Despite the heavy losses faced by companies exposed to AI disruption, the S&P 500 has barely moved since the start of 2026. So the natural question is, where is the money going? It is rotating into the physical world. Look at Coca-Cola. Since the start of the month, the stock is up 12%. Want another example? Look at waste management. The stock is up almost 7%. And then look at the energy sector. The entire sector is green. Even so-called boring utilities like Duke Energy are pushing to new highs. Why are utilities and energy outperforming? Because AI needs massive amounts of electricity to run. And you cannot prompt a new electrical grid into existence. You cannot even print a bottle of Coke with AI. In a world where digital content becomes infinite and nearly free, physical scarcity becomes the ultimate premium. That is why boring stocks are suddenly the hottest trade in the market. It is a flight to safety. So, how do we handle this? There are 2 ways to look at this drop. 1, panic and sell everything because AI is eating the world. 2, realize that the market is overreacting in the case of some companies. I am taking the second approach. I acknowledge the risk. Some companies will be disrupted by AI and those will become value traps. But I also believe there are elite software companies that are being sold off unfairly. If integrated intelligently with AI, they may create even more value for the customer than before. The key is to think critically about each company and about how AI might actually affect its competitive position. In this context, I would not sell any company in which I truly believe. And so far, despite my 8% drawdown, I have not sold a single position. This may actually be a rare opportunity to buy great companies at a discount. Next week, I am going to cover the other side of this trade, the Magnificent Seven and their massive spending problem. If you want to follow this journey to financial freedom and see exactly what I'm buying and why, make sure to subscribe. I will see you in the next one.